Okay, using vector error correction model, we can estimate the long-run relationship between the spreads and the our variable, so the shadow devaluation rate respect to Germany, the spreads in GDP in debt GDP ratio respect to Germany, the spreads in liquidity respect to Germany, and the corporate bond spreads, so the difference between the AAA corporate bond interest rate in USA and treasury bill in USA. What we can say about this long-run relationship is that this relationship is unstable over the whole period from 2000 to 2011. But we can split this period into sub-periods, in particular the pre-crisis period 2000-2007 and the post-crisis period 2008-2011. This table I, shows that we have the relation between these variables, so spreads, and this set of possible explanatory variables manifestly exists. In the pre-crisis period, this relation is statistically significant except for liquidity, but the coefficients are very low. This means that in this period, due to the fact that the spreads was in a narrow range, um, markets market perceived crisis, perceived euro as a whole. After this period, we can see the increase of each one of these components respect to the spreads. This means that markets started to price risk on a country by country basis, and we can see the impact of the both the increase on the coefficient both for the debt GDP ratio but also for the shadow devaluation rate, so the impact of the impact um, of this indicator of euro sustainability, and also the increase in the coefficient of uh, global risk aversion and the liquidity that becomes statistically significant with the sign we expect, so negative sign. Okay, in order to assess the relative contribution of each explanatory variables in our model specification respect to the spreads, we apply this equation in which we can derive, for instance, the relative contribution of the shadow devaluation rate respect to Germany is equal to the coefficient multiplied by the average in the period of the shadow devaluation rate divided by this term, so the relative coefficient and the average of each explanatory variable. What we find in the crisis period is shown in the first table. For the whole period, we can see that the major role is played by the global risk aversion and also the debt GDP ratio. But if we split the period in two sub-periods, in particular the period of Greek debt crisis 2009-2010, we can see, and the crisis of Spain and Italy government debt, we can see that the major role is played by both global risk aversion, but also the risk of euro breakup. In particular for Greece, this we can see that the risk of euro breakup is greater on as an impact greater than the global risk aversion. In order to estimate contagion from Greece, we detect the long-run relationship between the shadow devaluation rate of our panel, so excluding Greece, respect to the shadow devaluation rate in Greece. And what we found is that the coefficient in equilibrium, so over the period 2008 and 2012, is statistically significant. And if we compute the relative contribution, we can see that the expectation on Greek exit from the European Monetary Union is an important driver of the expectation on other countries. This is 34% over the period 2009-2012, and this percentage increased to 61% over the period 2009-2010 and 78% over the period to 2011-2012. This means that the coefficient, the contagion is from Greece is the most important factor, is an important factor in driving expectation of euro breakup. We can see on also the unit root test on level and first difference for the variable, the shadow devaluation rate of the periphery countries excluding Greece and including Greece, and the co-integration test, which shows that that we have a long run relationship between the shadow devaluation rate of the other countries and the shadow devaluation rate of Greece. So finally, our conclusion are we can see that the controlling for country-specific and global risk factors, we find that in the period of crisis, the risk of reversibility of the euro and contagion from Greece were fundamental drivers of sovereign risk premia in no-core countries. And we can see that this is a strong empirical support to the view that the debt crisis in the Eurozone is mainly due to the rise of a systemic risk fueled by expectation of a fundamental change in the monetary union setup, and these results are strongly consistent with the main implication of our theoretical model, which predict that in a monetary union financial instability can be transmitted through changes in the expectation and evaluations of its member countries, thus foreshadowing the occurrence of a euro breakup eventually. So this means that when a currency union is considered by markets as a fixed exchange rate regime, a monetary union is exposed to speculative attacks.